Hello, everybody, and welcome. I'm Mike Coe, and this is Open Interest. What interests you? Tell us in the comments below, and we'll try to address it in a future video. And please, thumbs up if you like the video, and show us your support by subscribing and hitting the notification bell. Okay, so we've received several thoughtful questions I would like to respond to. The one we'll be addressing today came to us via Twitter from Dr. Dan Lundy. Professor Coe, could you explain your answer? If volatility gets too steep, roll down and in. Thanks so much. Okay, so Dan, I think, is referring to a comment I made on last Friday's options action on CNBC, where I was referring to rolling a downside put position down and in. Now, when we talk about rolling an options position, we are referring to adjusting it to a different strike, a different expiration, or both. If I adjust an options position from a lower strike to a higher one by closing my lower strike position and opening a position on a higher strike, that is called rolling up. If I close a higher strike options position and open a lower strike position, that is called rolling down. It is also common to want to adjust the expiration date of an option position. Often as an expiration approaches, a trader will close the position and open a longer dated one. This is called rolling out, as in further out in time. Both of these elements can be combined, so I can roll an options position up and out or down and out. So last Friday, I referred to rolling a downside put position down and in. Down means I would be closing a higher strike position and opening a lower strike position. If out means adjusting a position to a longer dated one, then rolling a position in would mean I would close the longer dated position and open a nearer dated one. Rolling a position in is uncommon. After all, options positions are always getting closer and closer to expiration as time passes. It's uncommon enough to roll positions in that I wanted to discuss why you might ever want to do this. So to do that, let's work through an example together. And we'll wind the clock back a bit to, say, New Year's Eve, 2021. You're looking forward to the end of the pandemic, relishing the remarkable gains you've seen. We've had one of the biggest bull markets in history off the pandemic lows of March 2020. Champagne in hand, otherwise celebratory mood. You're reflecting back on the year that was 2021, and you can't help but think of supply chain snafus, the impact of unprecedented transfer payments, commodity price spikes, negative interest rates, real interest rates, and a shrinking labor force. And wondering how the year that was is going to affect the year that will be. Now you're worried. Something's got to give. 2021's transitory inflation will give way to 2022's persistent inflation. Persistent inflation will force the Fed to finally act. Tightening policy will slow the economy. Inflation, rising rates, slowing economy, a dangerous combination. So worried that that could impact your stock market gains, you decide you want to hedge. But there's a problem. When will the market crack? You've been listening to talking heads on CNBC talking about all these problems and railing against loose policy for months, yet the market has climbed ever higher. So your New Year's resolution is to put on a hedge. But on January 3rd, when you get back involved in the market, you realize that timing that expected downturn is going to be tough. So you could purchase short-dated puts and just keep rolling the position. That's a problem, though, because short-dated options decay more rapidly than longer-dated options do. So instead, you decide to look out to June 30th expiration, so half the year away. With the S&P approaching 4,800, the SPY 450 strike puts are about 16 bucks a contract. So with a $100 multiplier, that would represent a premium outlay of 1,600 bucks. And the idea here is that surely this anticipated downturn or some kind of a downturn is likely going to happen at least within the first half of the year. As it happens, it comes much more quickly. More and more data comes out, equities roll over. By late January, only a couple of weeks after our theoretical hedge, the S&P has dropped below 4,400. So the 450 strike puts by now are actually in the money. In fact, by January 25th, just about 3 weeks after we purchased them in this example, the options that cost $1,600 to hedge that $50,000 portfolio, that's about what that would be hedging, would now be worth about $3,600. So that's a $2,000 unrealized gain on the options position. And that would have reduced the total portfolio loss from the 10% that the S&P declined to about 6%. So feeling good about the hedge and convinced that the market crash is underway, you keep the protection of these on and do nothing. But then the market rebounds, very sharply actually. By February 9th, now the S&P is closing on 4,600, and the puts have lost much of the value that they had previously gained in that first big decline. So now they're worth about 1,900. That's more than the money that you originally paid, but you've seen 1,700 of your gains evaporate because you didn't take profits on the hedge. Now, this is one of the biggest challenges for long equity investors that use options. What good do hedges do if you don't take any profits when the market declines? Especially if your holding period is going to be measured for the stocks, it's going to be measured in either years or maybe even decades. After all, in the long run, stocks will likely recover from these dips and be higher, maybe much higher. So recognizing this, now you vow to take profits on your hedge if the market swoons again. As it turns out, you don't have to wait too long. Soon after this, the stocks actually do start declining very sharply again, this time even further than they did before. So by February 23rd, the S&P is at 4170. And by this time, the June 30th 450 puts are once again well in the money, not inclined to repeat what you might perceive as a previous mistake not to take profits the last time. Now you feel compelled to act. Once burned, twice shy, and all that. But there's a problem. Turn on CNBC, talking heads are ranting that this is only the beginning, full-blown market crash is now underway, and that the S&P is going to go down to, I don't know, 3,000 or something like that. What do? Well, you could roll the June 30th 450 puts down to the 400s, but the 400 puts cost about $1,750, and that's a big chunk of the 4,100 that the 450s you own and would be trying to take profits on are actually worth. And this is because as the market is moving around this violently, implied volatility has skyrocketed. Skew has also steepened. So even those 400 puts expiring in June 30th are also very expensive as investors are kind of panicking at this point. So what do you do if you want to take some of the profits that you see on your 450 puts that expire in June, but still maintain some protection? Well, you could at this point consider purchasing nearer dated options, such as the March 18th 400 strike puts. Now, at that point, those were about $500, $5 a contract. So considerably less than the 450s you'd be selling, and considerably less than the June 30th 400 puts would be. Now, by doing this, you're going to be taking a $2,500 profit on the 450s that you are selling, and then you're going to spend $500 on those March 400s. Essentially, you're booking $2,000 in profits. That's the worst possible case at this point. But what you're able to do now is both take profits while still taking cover of further declines in the event that this swoon is going to turn into a crash like you saw in 1929 or Black Monday in 1987. As it turns out, by March expiration, the S&P recovered again. So those March 400 puts that you spent $500 to buy actually end up expiring worthless. But you had already realized, even net of that spend, a $2,000 profit on the hedge overall. So by March 18th, the S&P was down about 6.25% from the January 3rd level where this whole thing began. But net of the $2,000 profit that you took on the hedge, even spending on that down and in put, the losses on a $50,000 portfolio hedged in this way would actually only be 2.25%. So folks will sometimes put longer dated positions on to capture an anticipated event, but where the exact timing of that event is uncertain. Once that anticipated move begins, though, the timing uncertainty is no longer as much of a factor. And that is when you can consider rolling a longer dated position to a nearer dated one, assuming that there's still considerable amount of time remaining on the longer dated one. and oftentimes also to a different strike. So you're doing two things. You're trying to reduce the cost of the overall options position by making it shorter dated, and also by choosing a different strike. And this way you can still maintain some of the directional exposure for a move that's already underway. In fact, I actually saw a considerable amount of exactly this type of activity by institutional traders in SPX options last week, which is what served as a reminder for me to mention this, which is a less common approach to adjusting options positions when we were on the air last Friday. It's helpful to understand how the value of options change as the price of the underlying moves, as implied volatility changes, and as time passes. And we'll certainly cover those and other sensitivities in greater detail when we cover what options traders generally refer to as the Greeks. But for now, just to keep it simple, as time passes and prices move, adjust your exposure accordingly. If you want to take profits on long options positions, you can roll call options up to higher strikes. You can roll put positions down to lower ones. If you need more time because an anticipated move has not yet occurred, roll shorter dated options out to longer dated ones. But occasionally, you will seek to take money off the table, but still maintain some exposure if a move is in process, if it's already underway. And the uncertainty regarding timing is no longer a factor, and that can be the case for rolling a longer dated position in. For Dr. Dan Lundy and others who wondered what I was talking about, I hope that helps. That's it for this video. I'll see you in the next one. Send us your comments, like and subscribe, and hit that notification bell. And as always, thanks for watching.